Welcome to Globefolio. The most difficult thing to do right now is to put your money on stock. That is the truth. In short, stock market is actually risky at this point. If you don't know what to do with your money, maintain the cash portfolio. Just leave it as cash. Because if you put your money in the wrong stock, you will likely lose a lot. In short, you might likely lose close to 15, 20, or 30% of your money in the stock market. As you can see on charts, the S&P 500 is already down from a high of 4,700 basis points to 3,858. As I'm doing this video, as I'm recording this video, in just few hours, the US Fed will be announcing another rate hike. And analysts are actually expecting the US Fed to either go with 75 basis points or 100 basis points. If the Fed goes with 75 basis points, then it's going to be a lot softer, meaning that investors are not going to react like that because that's still in line with expectation. But if they go with 100%, this will likely crash the market further. However, even if they go with 75 or 100 basis points, the cumulation of increase or the multiple rate hike that we have experienced from the beginning of this year since March up to this time should not will most likely not help the stock market. It won't even lift the stock market at all. So even if they decide to go with the rate hike as expected, the market is largely bearish, meaning that from now to the end of this year, as the Fed had promised, we are going to see more rate hike, and as the Fed looks forward to bringing down inflation to 2.5% target, it means that rate hike is not ending anytime soon. So that automatically means that the stock market will most likely suffer. The stock market will be pressured between now and end of the year. This is not only limited to the US stock market, even in Nigerian market. The central bank is already promising another rate hike, meaning that we are likely going to see our market get hammered by increase in interest rate. Increase in interest rate is not good for stock market and has never been good for stock market. You can see right now, you can see how the Nigerian market had been down successively in the last 1, 2, 3, 4. So if central bank decide to increase rate again, we will likely see the market tank further. In the midst of all this, does it mean we should stay away from stock market completely? Does it mean the stock market will no longer be profitable again? No, not so quick. In this video, I'm going to show you how to find bulletproof stock. Stocks you can still buy right now, stocks that are experiencing massive surge, stocks that are attracting attention, even as US rates, even as global central banks continue to increase interest rates. So this type of stocks, they are not affected by rate hike. This type of stock are still solid, they still remain strong. In short, they continue to experience increase or price appreciation as other stocks suffered. So these are the things I'm going to share with you in this video. What happened during rate hike? One, the cost of borrowing is going to be a lot more expensive. When the central bank or US Fed increases rates, what does that mean? It means that when you go to your bank to borrow money, the bank is going to charge you more. It means mortgage rate is going to be extremely expensive. If you're a small business and you finance your business with debt, expect your finance cost, expect your interest expenses to surge higher, to be higher. So that automatically means that you will want to pass on costs to your customer. So things are going to be it's going to be a lot more difficult for you if you rely on debt. So let's first discuss the implication. What is the implication of rising interest rates? Why does stock suffer during rising interest rates? So let's discuss that. First one, like I said, the cost of borrowing is going to be a lot more expensive. Now, when you look at the financial statement of most companies, what happened? There's one line item in your profit and loss which we call the finance cost. The finance cost tells you how much the company is paying to service its debt. Another name for finance cost is interest expenses. So if the Fed continue to increase interest rate, or if Nigerian central banks continue to increase interest rates. It means that if you borrow, if you actually use borrowed funds or you use debts to run your operation, expect your finance cost to increase because the rate at which your lenders are going to charge you for borrowing more from them will automatically go higher. So finance cost is going to increase. And if finance cost increases, it's going to affect your profits. It's going to affect your profits. It's going to affect the amount you actually pay back to your shareholder. So if tomorrow you declare 10 billion as profit, expect to pay more as interest expenses. And if your profit is affected, what happens? Your earnings is also affected. And your earnings is affected, valuation for the company will also be affected. Then automatically share price dip. So that's why you see that rising interest rate is not good for stock market because most companies listed in stock market tends to tank. Investor tends to react negatively to rising interest rates. Another thing again that makes that another implication again is that when there is increase in interest rates, we are going to see rising bond yield. So bond yield is expected to increase. Why is bond yield increasing? The price of bond and yield they move in inverse direction, opposite direction. So because you know that the next bond that will be issued by either the central bank or the government will come with higher rates, you tend to dispose the current bond. And as you continue to dispose the current bond, the price goes down. And as price goes down, yield goes up. That's why you see that whenever investors are expecting central banks to increase interest rates, you tend to see 10-year yield, 2-year yield, 30-year yield, most bond yield will start rising because the bond price and yield they move in opposite direction. Now, as bond yield continues to rise, what also happens? It makes the fixed income market a lot more attractive. So when there is rising interest rates, what happens? Return on fixed income market will be attractive. Return on fixed income market will be attractive. So as you continue to see rising interest rates, it means that if the government needs money at this point, the yield, the interest they're going to pay you for borrowing from you will be a lot more higher than what it was before. Now, if the interest on fixed income market is attractive, investors will prefer to move money away from stock into the fixed income market. This explains the reason you have been seeing the Nigerian stock market tanks. This also explains the reason the S&P 500 is also dipping. You can see how the market, how the index had dipped from a high of 4,000 down to because people, investors are taking money, are moving money away from equities. Why are they moving money away from equities? Fixed income is increasing, and finance cost is increasing, and fixed income market is a lot more attractive. So there's going to be a fund flow. There's going to be massive exodus of funds from equities into the fixed income market. So as Fed continues to increase rates, expect the stock market to dip. So even though we might see the market rally because the rate increase is in line with expectation. But overall, if when you accumulate those rate hike over time, you are going to see that the cost of borrowing will be a lot more expensive for companies, and that would affect the stock market. And also, you can see from what I shared here, the rising bond yield will make the fixed income market a lot more attractive. And then the next bond that will be issued, the next uh, commercial paper that will be issued by companies, the next treasury offers that you're going to see will come at a higher rate compared to what it was before. That's why investors sell off their bond that is offering the current yield, your current rate to buy the new one. So what I mean by that is that if the current bond is probably offering 2.5% and a higher yield or an increase in interest rates is going to give you 3.5%. What does that mean? I'd rather sell off the one for 2.5 and then wait for the one for 3.5 to come so that I can buy into that offer. So that automatically makes the yield on the current one start increasing. So this three summarizes why you need to pay attention to increase in interest rates. So don't just think that it's not going to affect me. As long as you're an investor, as long as you trade equities, as long as you invest in money markets, you need to pay attention to this. This is very, very important. So what opportunity does this create for you? What opportunities does this create for you? In the midst of this rising interest rates, there are hidden opportunities you need to take advantage of. What are the opportunities? The first opportunity is that bond and treasury bill will be attractive. So move your money into So opportunity first is move your money into bond or treasury bill. So because the next treasury bill right now will come at a higher rate. So that's the first opportunity. Second opportunity again is that you will likely move your money to euro bond. So you can check my previous video. I've talked about this and I've also talked about euro bond and how that you can put your money in euro bond since the dollar has always gained against the naira. So this also creates another opportunity for you to move money. So it's important for you to understand economic trend. Interest rate is a sign of change in economic cycle. When the central bank is increasing interest rates, it makes money market a lot more attractive. When they are reducing interest rates, it makes money market unattractive and then it makes stock market attractive. So right now, you need to know the period that we are in. We're in a period of rising interest rates. So amid all these things, does it mean that the stock market is no longer a viable place to invest in? Because like we said, you can see the stock market is tanking, both the Nigerian market and then the US market, not so fast. Even in the midst of these interest rates, there are still powerful stocks that you can take advantage of right now. I'm going to mention one of them and then use that to explain um, how that you can actually pick good stocks in this market. So one, I call them the bulletproof stocks. Why did I call them bulletproof stocks? These are stocks that are shielded. These are stocks that are not hammered. These are stocks that are defensive. These are stocks that are actually doing well in the midst of these uncertainties, in the midst of this market crash. These ones are doing extremely well. So one of the stocks that I'm going to mention right now is DINO. DINO, which is HF Sinclair Corporation. DINO. So you can see right now, DINO. This is stocks that I'm going to mention right now. So let's look at the performance of this company over time. In the same period that the S&P 500 is crashing, you can see here 1, 2, 3, 4, 5, 6. In the last 6 months, you can see how S&P crashed from 4,500 down to this period. So let's also put up SPS 500, SPS 500. So this is it. So in the last 6 months, you can see that SPS is down by 13.21%. On year to date, is down by 19%. In the last 1 month, is down by 6.43%. In the same period, look at HF Sinclair. In the last 6 months, this stock is doing 40%. It's doing a whooping 40%. This is the same period that we are experiencing rising interest rates. In the last 1 month, this stock is doing minus 2%. On year to date, this stock is already doing 51%. So what is that specialty? In the last 1 year, it's doing 70%. So in the last 1 year, SPS is down by 11%. On the year to date, it's down by 19%. In the 6 months, it's down by 13%. So the best way to gauge stocks that are performing the market over time is to look at year to date, 6 months, and yes, year to date, 6 months and 1 year. Last, you can't use 1 month because market is subject to fluctuations. It's subject to demand and supply. So it's best to use 6 months, year to date, and 1 year. So this stocks in the last 1 year is up by 70%, year to date is doing 51%, and 6 months is doing 40%. What is that special thing about this HF Sinclair Corporation that is making this company outperform the market, even in the midst of market crash, and these stocks keep outperforming the market? This is a perfect example of bulletproof stocks that I'm talking about. Stocks you should be buying because they are outperforming the market. So let's look at the business of this company. HF Sinclair Corporation is a diversified energy company that manufactures and sells products such as gasoline, diesel fuel, jet fuel, renewable diesel, specialty lubricants. So they are more or less like energy, they are energy companies. So you can't say that because they are in energy companies, that is why they are outperforming the market. No, That's not so fast. So don't just conclude and say, oh, all energy companies are performing. You can check on other energy companies and you will see that they are doing down. In short, they are even underperforming the S&P 500. So what is so special about this stock? So I'm going to tell you what are the things you need to watch out for. Remember, we are in a period of rising interest rates. Most stocks that are tanking right now is because they are being affected by rising interest rates. In short, a lot of companies are issuing guidance. Analysts are revising their valuations or fair value of different companies because a higher rate automatically leads to lower fair value estimate for this company. So number one reason why this company is actually surviving this market crash is because it has what we call low debt to equity. Low debt to equity. That's number one reason. Now, why is this very important? When the Fed is increasing interest rates, remember the first point I raised. I said the cost of borrowing is going to be expensive. Now, the cost of borrowing is the amount you pay back your lenders for actually borrowing money from them or for having access to cash or for them disbursing some cash to you. So, if the cost of borrowing is going to be a lot more expensive and this company is not exposed to debt at all, it means that debt to equity is very, very low. What does that mean? It means that rising interest rates does not have anything to do with them. They are not exposed to debt. So when other companies are battling on debt restructuring, debt financing, um, just revisiting their creditors to see how they can help restructure their debt and also make it easier to pay back. This company is not bothered. This company is not bothered about it because they have a very low debt to equity. So how did I know that? Let's quickly launch FinViz. So we're going to use FinViz to do our analysis. So while I'm sharing this with you, we're going to be looking at the metrics live on FinViz. So that way we would not assume or you will not think that I'm just saying things from my head. So I wanted to see live as analyzing the stock. So this is FinViz. So DINO. So HF Sinclair. So this is HF Sinclair. Now, the first thing I said is debt to equity. Look at the debt to equity of this company, 0.000. In short, I'm not their debt to equity is almost at zero level. Do you see debt to equity zero? So meaning that if the US Fed continues to increase interest rates, this company is no longer it will not be affected. Their cost of financing, their cost of debt is almost at zero. That's what this means. Is almost at zero. So such kind of companies are not exposed to rising rates. You can also see the performance of this company year to date 58%, 74%, 43 in the last 3 months, 10%. Can you see? So cost of debt is very, very low. So these companies are not affected. So even if the Fed continues to increase interest rates, this is one of the few companies that will not be affected by that higher rate. This is why it's important for you to pay attention to this type of bulletproof stocks. They are not exposed to debt. So that's the first one, low debt to equity. What if it has high debt to equity? High debt to equity is not something you want to go into. Even if a company has high debt to equity, it's not bad, but what you need to pay attention to interest cover. So I'm going to show you how to analyze stocks with high debt to equity because there are some companies that actually rely on debt to finance operation and they are making enough money than that, meaning that the return on that investment is far higher than the cost of equity. But right now, we're looking at stocks to buy that fit the current economic climate, that fits the current market cycle. And the market cycle right now is that the global central banks are increasing interest rate and the stock market is tanking. So what's the best kind of stock to buy? That's so we're going to dedicate this video to that. So first one is low interest rate. Now having picked stocks that have low interest rates. The next one we want to look at is the company must have, pay attention to this, the company must have ample cash, must have enough liquid assets or liquid, yes, including cash. Now, what are liquid assets? Liquid assets are assets you can easily convert to cash. For example, they have enough cash, they have current account, they have enough savings in the bank. So these are the kind of companies again, because when they have low debt to equity and are enjoying ample cash, that gives them an access to investment too. Remember, one of the advantage of higher interest rates is that money market becomes attractive. So that means the rate at which these companies are actually going to earn when they put this money in fixed income market, when they put this money in treasury bills, certificate of deposit, whatever, they are going to earn higher rates. So that also going to add to their bottom line, meaning that their interest income will also be a lot more higher, because higher interest rates amounts to higher return in fixed income market. So imagine that these companies, they have ample cash and then they are investing that cash in fixed income market like bond. They're also putting that money in treasury bill. So rather than them using that money to settle debtors, settle creditors, I mean, because they don't have major debts to pay, they don't have cost, they don't have finance cost to settle. Their cash, that cash is theirs, and rather they can either do two things with the cash. They can either invest that money to earn higher return. Number one, they can also use it to buy their shares. That's what we call share buyback. So they can even distribute to shareholders as dividend, which is good, which is going to be a lot more attractive, which makes their stocks to continue to surge, because investors will like that kind of company because they are actually using their cash well. Number one, they can invest in liquid, they can invest in physical market. Number two, they can actually use it to finance expansions too. Number three, they can buy back their shares, or they can even use it to, they can distribute it as special cash. It can be special distribution or dividend to shareholders. So these are the kind of things you need to watch out for. And then the third one is they should have their current ratio. Current ratio has to be above 1 or 2. What is current ratio? Current ratio is when you compare the current assets and then also the current liability of the company. You can see here, when you compare the current asset and the current liability, now that current asset and current liability tells you whether the company has enough cash to pay up its short-term debt or its short-term obligation. So we want to see this above 1.5 or 2. That also tells you that the company is even able to pay their current asset and current liability without any issue. So these are the kind of companies you want to buy. And if you look at HF Sinclair, they actually meet that checklist. They have ample cash. Now, how do you check for companies that have ample cash? It's very, very easy. What you need to do is to look at their cash flow from operation. So make sure cash flow from operation is positive. So when you look at their cash flow from operation, under their cash flow statement, it should be positive. That means that the company is generating cash from its operation. So imagine in this high risk, high rate environment, a company that has low debt to equity is not exposed to debt. Rather, the company is even generating more cash from its operation, and then it has a high current ratio, meaning that the liquid cash it has, the cash it has can actually pay up the current debt that it has. This current debt might just be short-term debt. That's the kind of companies you want to buy, because the major reason this market is tanking right now is because the Fed is increasing interest rate. And increasing interest rate is going to make the money market a lot more attractive. It's also going to make the cost of borrowing very, very high, which will also affect the stock market. So if you look at all this, then it means that there are stocks that you can actually buy in this market. So let's look at our screener. So I'm going to show you some of the things I do in my screener. Just today, I recommended few stocks that pass this checklist. Few stocks my subscribers can buy right now, even as the market continues to crash. And this stock is one of them. And I also recommended like three stocks together with DINO. Stocks that have outperformed the market by double digits, and I still think will continue to surge higher even as Fed continues to increase interest rate, because these ones are not affected by increasing rate. So let's look at all these metrics to come up with a search on the stocks that we should be looking at. First one is debt to equity. Remember, we're using trading view as our screener. So we're looking at debt to equity, number one. And then number two, we are looking at current ratio. And then number three, we have cash flow from operation. So because there's no way to check cash flow from operation, what do you do? What I do sometimes is to look at my price to cash flow. So why am I looking at price to cash flow? It means that if cash flow is positive, then price to cash flow has to be positive. So these are the three metrics I want to check. First, debt to equity must be very, very low. So I can say debt to equity must be below 1, meaning that they are not exposed to debt. Debt to equity below 1. And then current ratio, I can say current ratio above 2 or current ratio above 1.5. And then this must be over 5. Now, why did I say over 5? There is no specific number here. If cash flow, free cash flow, if free cash flow is positive, then automatically it means that cash flow from operation is positive, because free cash flow is cash flow from operation less capital expenditure. So if cash flow from operation is positive and higher than capital expenditure, then free cash flow has to be positive. So these are the kind of stocks I want to buy. So you can see we've done our screening, and then right now we arrived at 995 stocks. But that is not all. There are other metrics that I use to check for this. Another one is the company has to be profitable. So I look at return on equity to make sure I only pick companies that are profitable. So I can say return on equity above 0, and then I can say my price to earning ratio must be above 0, and then the current quarterly earnings that's trailing 12 months must be 0, meaning that it's a profitable company. So if we do all this, we have 774 companies. But I've already done my checklist. I have a full checklist that I've done to scan for this market. I've done my full checklist to scan for stocks in this market. So I don't need to bother my head around trying to do that all over again. This is why I created my community, to make the job easier for them. So what I've just done is, if I pull in my screener, you can see here, if I pull in my screener right now and I select it, it automatically bring out this. You can see bulletproof stocks to buy amidst rising interest rates. So once I select it, automatically it's going to show all the stocks that meet my criteria. But like I said, this is one of the few stocks that I have bought in that that you should buy in that pool of stocks. If you want to get the rest of my stocks, join my community, and I'm quickly going to share them with you so that you can take advantage of stocks that are rising right now. If you come here and we input DINO in our screener, you can see right now, you can see how that stock is surging higher. You can see last month it did 10%, and then you can see how the stock is recovering from the bottom. So these kind of stocks we want to buy. Despite the fact that the market is tanking, you can see how the stock has been doing well um, since November last year. So if you go back to October, okay, that's January. From January this year, you can see how the stock has moved from 30 to 51. In the same vein, the S&P has dipped from 4,500 down. So these are the stocks that investors are gradually buying. Why? Because they meet the criteria of a bulletproof stocks. Bulletproof stocks, stocks with low debt to equity, which makes them resistant to higher interest rates. They have ample cash. That means they generate cash from operation. They have high current ratio, meaning that they have enough cash to pay off their short-term liabilities. So all the effect of rising interest rates is not going to affect them. Rather, they are going to take advantage of rising interest rates. So because they have ample cash, they are even going to be buying bond. They're going to be investing the money in money markets to get more return, which is why they are actually growing. So in addition to the profit they are generating from operation, they are also going to earn more return from the cash that they have. So this is how to be able to pick bulletproof stocks in the stock market. So even while the market is tanking, don't think that stock are actually going down. So let's try that in Nigerian market. So we don't limit this strategy to the US market. So I'm going to show you how to also do the same screening for Nigerian stock. How do you do the screening for Nigerian stock? The same thing. You come here, you select debt to equity, number one. Number two, you want to select stock with current ratio, and then price to free cash flow. And they also must be profitable. So here we're looking at return on equity of this company. So here we have debt to equity which has to be below 1, meaning that they are mostly funded by equity and not debt. So, and then the current ratio of this company should be above 2. And then our price to free cash flow must be above 0. That means it's positive. And then our return on equity has to be above 0. So let's see, above 0. So you can see right now. So look at you can see the stocks. We have Better Glass, we have Cheap PLC, we have Sovereign Insurance. You can see them: Better Glass, Cheap PLC, Sovereign Insurance, debt to equity below 1. So current ratio, you can come down here and say current ratio above 1 or above 1.5. And then they have positive free cash flow and the return on equity. So you can see another list of these companies. You have them here: Better Glass, Fitson, Okomo Oil, QTs, GPLC, Julius Berger. You can see here. So these are stocks that have ample cash and that will likely survive the market as rate continues to spike. Now, when you have debt to equity below 1, pay attention to the ones that have debt to equity near 0. Like this company now, you can see this stock, this one here, which is Beja Paints. You can see Beja Paints has almost 0.02. That means they are not really exposed to debt. And then current ratio above 1.5, price to cash flow, and then you have return on equity. Then you can also see these stocks too. Very impressive. You can see almost 0.01 and then 129. That means they have enough cash to cover up. So when you see um, a higher number for this current ratio. That's this current ratio is used to record to gauge liquidity. So it means this company is liquid enough for them to have 129 times their current liability, and that's sovereign insurance. You can see right now. So you can run a check. So, but it doesn't mean that this is a buy for all the stocks. No, there are other things I run a check on. What I've just done is fundamental analysis of this company. Fundamentals tells you what to buy. Then technical tells you when to buy. What I've just done now is fundamental analysis. It's telling you what you should look at, but doesn't mean you should quickly go and buy them right now. So that leads us to technical analysis. So technical analysis is where you begin to analyze these stocks on chart. So because I may not have the time to analyze each of these stocks, and there are informations that are only limited to members of my community. So I would advise that you join my community so you can get access to the information, because I take my time to do all this and then post the few stocks that I know you should be looking at in the market. So these are the few things that I want you to learn right now on how to find bulletproof stocks in this market. So as rate continues to rise, don't think that it's all the stocks that are going to tank. There are few stocks that will survive this rising interest rate, which I just shared with you right now. So if this is the first time you're watching this channel, feel free to hit the subscription button and turn on the notification bell so that when I drop an update, you always get a notification, or you get an alert, or you probably receive a message from my channel that I have a